Hello, everyone. It's Steve with Aptera Owners Club. Okay, let's walk back to May. May 15th is when Aptera put out this, when they put out their May update, and they put out this press release saying Aptera engages US Capital for production funding. This was a little bit confusing for some people because they thought that this meant that they had gotten the funding and that funding was secured for production and that US Capital was giving them the funding. And so I made a video soon after that and wanted to make it very clear that it doesn't mean that US Capital is giving them funding. It means that US Capital is going to help them get the funding. They're going to be the investment bank that tries to find investors or tries to find some kind of funding source to get them the money for funding. And so they are partnering with US Capital to help them do the fundraising. And this helps because US Capital has like a stable of large investors and they have a lot of experience in doing this kind of funding. Now, what we did not know at that time, and there was a lot of speculation in that video and in our community, like what kind of funding is Aptera looking to get from US Capital? Is it going to be equity funding? Are they going to release more shares and they're going to be a special kind of equity shares that US Capital is going to deliver at different terms than they had been doing with the crowdfunding? Or there was some talk in that May update that the intellectual property, especially the solar intellectual property, was deemed to be pretty valuable, and they would use that as collateral to get debt funding. So like they would take out a loan and use the intellectual property of the solar patents as collateral. So if they default on the loan, they would have to hand over the solar intellectual property. So, we didn't know whether it was going to be debt or equity. Well, most recently in the past couple of weeks, they've released this. They released that basically US Capital announcing a $60 million convertible note offering. And then if you click on this little hyperlink, it leads you to here. And from here, you can get the Aptera Motors investor presentation, and we've gone through many parts of this investor presentation, as well as this Aptera Motors executive summary. And so here's the executive summary. And when I first heard about this, $60 million convertible note, I honestly didn't know what a convertible note was. I'd kind of vaguely heard that term a couple of times reading some business news, this, that, and the other, but I had no idea what a convertible note was. So I looked into it, and I think I figured out what it means. Those of you guys who are in finance that may know more, let me know if I made a mistake on this, but I looked it up, and I'm pretty sure that I understand what's going on here. So as it turns out, a convertible note is basically a loan that an investor gives to Aptera, and then at a certain point in the future, when some kind of liquidity event happens or some kind of fundraising cycle happens where a stock price is established, then it converts to equity. So in some ways, where everyone was right. It is both debt and equity funding. It is debt funding that turns into equity in the future. So it has some advantages and disadvantages, both for the investor and for Aptera. And what's interesting is this convertible note is something that's very similar to something that Aptera has already done called a SAFE agreement. So here is a website called Diligent Equity, and it says SAFE note versus convertible note. What is the difference? Why not just use equity funding? So the reason that people don't use equity funding initially is, you have no idea how much your company is worth. And Aptera did some kind of valuation, and they evaluated the company. And you guys remember the first couple of rounds of crowdfunding were like 80 cents a share, and then there was like $3 a share, and then most recently it's like $10.50 a share. But this is like valuation that Aptera has done internally, and we don't know how it will turn out when Aptera actually hits the market. Because when it actually hits the market, and we've talked about this several times, the market will determine the value of the company by what the stock shares trade at. Um, but with that's why equity funding is a little difficult, because the investor and the company have to come to an agreement on what they feel like a good valuation is, of that company. And a startup company is very hard to evaluate. You don't know how well they're doing. There's a lot of unknowns. You don't know if they're going to make it or not. So it's a high risk proposition with unknown valuation. So in that case, they do something. Aptera did something called a safe. They did a bunch of safe agreements, and if you look back at their annual reports and you look up safe agreements, you can see this is kind of their history of how they've been raising money. Between 2019 and 2020, they sold safe agreements in the amount of about $500,000, and then 2020 they did another $1 million in safe agreements, and then in 2021 they did another $500,000 in safe agreements, and then later on in 2021 they did $1.7 million in safe agreements. So in total they've done about, let's see, a million, 2 million, three, close to $4 million in safe agreements. And then that's of course dwarfed by all the crowdfunding they've done. But these safe agreements basically are basically, you give them money and they say, okay, you just give us money, we're going to use it to build our startup. And then at some point in the future, when we have another fundraising round, then we will convert your money to that equity. And I talked to Aptera and they said all their safe agreements have now converted to equity. So they don't have any outstanding safe agreements left. They've all turned into stocks. And when you do a safe agreement, there's something called a discount rate. So let's say that someone had given them, $500,000, or some people invested $500,000 in them in early 2019. This was before there was any kind of WeFund round or anything like that. And then there's a crowdfunding round, and it went for like 80 cents a share. And then what the people that gave them the safe agreement, depending on what the discount rate was, let's say the discount rate was 20%, they would get 20% off of the 80 cents. Okay, just to make the calculations easier, let's say that Aptera sold their stock at $1 a share. The people that got into these safe agreements before that would get their shares for 80 cents a share, so 20% off of $1 a share. So they instantly, on paper, make 20% off of the investment, because now they've bought their investments at 20% less than it's being offered to everyone else. So that's kind of the advantage of giving them the money and the safe agreement. But the reason that safe agreements are better for startups is that these convertible notes, and again, the convertible notes is what US Capital is offering, $60 million in convertible notes. So the convertible notes are really lengthy documents. You need to get lots of lawyers involved. It's very, very involved. And so it takes a long time to go back and forth and draw up these probably several, like 100-page documents. In contrast, safe notes are like 5-page documents, and they're very straightforward. Basically, the only thing you have to agree on is like what the discount rate is, and maybe like some rough evaluation of the company valuation, and just a couple of very standard things. So they're very simple and fast, and the founders who founded the company retain a bunch of control of the company with safe notes. So that's what they're doing. So safe notes are in many ways not as investor friendly. So as an investor, you get a better deal with a convertible note, from my reading of it. And the company, the founders, get a better deal with the safe notes. Okay, so what's the difference between a safe note and a convertible note? They're the same in that you give them money and it converts into equity at some later date. The difference between convertible notes is that there's a term on a convertible note, and there's a time when it has like something has to happen. You have to either give them back the money, or you have to renegotiate the terms of the agreement. With a safe note, there is no term. Like it could be like 3 years or 4 years or 5 years before it converts or something happens. You kind of are trusting the company a little more with the safe notes, unless something's been written into the safe note differently. But generally, there's no term on a safe note. On Apteras Safe Note, so if you look at this investment summary, there's a term. It's 24 months. So basically, after they fund this convertible note, Aptera has 2 years to either give them back the money or have a event where it can turn into equity. So they either have to get bought out by a bigger company or go IPO or have another fundraising round that they like people agree on. So I think the plan is Aptera is planning on going IPO within 2 years of this convertible note offering. At the IPO, a share price will be determined at the IPO, and then it'll convert to the stocks at that time. All right. The other thing that happens that's different between a convertible note and a safe note is that because a safe note is you just giving them money, a convertible note is actually a loan. So there's interest during the term. And that's what you see right here. It is the coupon rate. And they're saying that it can be up to 12%. So Aptera would be paying 12% interest, up to 12% interest on this for the next 24 months. And then the other thing that's different is this is the same between the safe note and the convertible. There's a discount. And the discount in this case is up to 20%. Another thing that happens is there's something called a valuation cap. And you say, like, this is the maximum that our company will be worth to you. So, for example, let's say that Aptera does very, very well, is very successful, and the valuation skyrockets. And current valuation at $10 a share, I think it's like $800 million roughly for Aptera. Let's say they do really, really great. And when they IPO, it's worth like $8 billion. And so, share price is like $100 a share. And then all of us who invested, we're all very happy. These guys who are investing in the convertible note, they want to mitigate that risk. So they want a valuation cap. And so they'll negotiate something called a valuation cap. And it may be like $2 billion. Even if the company becomes valuated at $8 billion at IPO, these guys won't pay more than if the company is worth $2 billion. So if the price is like $100, they won't pay more than $20. That's their cap. It'll cap out on that. So it protects investors in many ways. Like the convertible note is very favorable to investors in that, one, you get interest for 2 years and at a pretty good rate, up to 12%. And then you get a discount. So for example, let's say that Aptera goes IPO in 2 years. And let's say the IPO price is $10 a share. So the people who went into crowdfunding, it's $10 a share. And so they probably lost a little money because they paid $10.50 a share. These people will have made 12% on their investment for the 2 years. Plus, they'll get 20% off of the $10. So they'll get it at $8 a share. So you can see that they've made like little over 24% already over 2 years. Plus, they'll get a 20% discount. So it's pretty favorable for them. And if Aptera does very, very well, they're gonna get a cap, a valuation cap, and they don't talk about the valuation cap in this offering. And then if Aptera does, not so well, let's say that it IPOs and it's like $1 a share. Then the people who got in at crowdfunding at $10 a share, they lost 90% of their money. These people, they still get the 24% interest for 2 years, so they made that. And then if it goes at $1 a share, they're going to buy shares at 80 cents a share. So that's way better. So it's almost the way that this thing is set up, as I understand it, is as long as Aptera goes IPO, so as long as they have IPO, they make it to IPO and they have a IPO offering, these people are going to make a ton of money. They're going to do very well. The risk for them is if Aptera goes bankrupt and never goes IPO, then they're doing very poorly. Or if they go IPO at such a low price that it's like becomes instantly, worthless because the market decides that Aptera is not worth anything as a company, then these people lose out. But they are in a much better protected position than the people that went into crowdfunding, because they get interest and they get a discount at the IPO price. And the only way that I can see that the crowdfunding people do better is if Aptera does well and the IPO price is higher. Like that, let's say if the IPO price is like $20 a share or $30 a share, then the people who went in crowdfunding did better than these people, because these people are going to have to pay the $20 or $30 a share with a 20% discount. But it's still not going to be $10 a share. So the people who got in at $10 a share are doing better. And so the people who did crowdfunding will do better if Aptera IPOs at a fairly high price. But if Aptera IPOs at at $10 a share or $5 a share or $1 a share, these people are going to do much, much better than the people who went into crowdfunding. So that's actually what's being offered. And these terms are somewhat vague. It says up to 12% and up to 20% discount. What this means is US Capital has not found investors, and they're going to negotiate with the large investors. So these people that are buying these convertible notes are not putting in probably like $100,000 or $200,000. They're probably putting in a minimum of like $500,000, maybe several million, and maybe even like 60 million. Maybe there's one investor that's wanting to put in $60 million. These large investors have more negotiating room, and they're going to negotiate terms. And it could be, this is like the best terms they're saying, hey, this is the best case scenario is you get 12% interest and 20% discount. Might be 6% interest and 10% discount. I suspect it's not going to be that bad. I suspect it's going to be fairly close to this, but I don't know. That's what US Capital is doing. They're going to find their stable of large investors. They're going to say, hey, look, we have this opportunity for you. Are you interested in this? And someone's like, yeah, I'm kind of interested in this. And, if you give it to me at 12.20, I'm in. And then someone else will say, I'll do it for like, 10.15. And so they're going to find what the best deal for Aptera is. And they're going to figure this out. Also, these convertible notes, you don't have to give them equity. So because if you give them equity, it causes shareholder dilution for everyone. So everyone gets diluted. The founders get diluted, crowdfunders get diluted, accelerators get diluted. And so they talked about dilution in their SEC filings, right? Company plans to raise significantly more capital, and future fundraising rounds could result in dilution. And if you go down, they talk about what kind of dilution: immediate dilution, future dilution. And this is future dilution. And they specifically say this type of dilution might happen on conversion of convertible notes into shares. Okay, so that's what they're talking about. And if you have this and you convert them to equity, it'll cause dilution for everyone. However, let's say that Aptera finds more favorable terms with another investor in the future, and they have lots of cash available. They have the option of just paying this back as a loan and not converting it to equity and causing no shareholder dilution. So if you have a lot of cash and they feel like the company is doing well, and they don't want to dilute because they want to protect their shareholder value and protect the founder's value in the shares, they can just convert this as equity. But let's say that they don't have money, they need the cash, and usually most startups need cash. Cash is like the blood, they can't survive without cash, and usually almost every startup is cash strapped. They're not cash rich. In that case, this is much better than a debt, because you don't have to pay them back in cash. You can pay them back in equity. And equity is something they have. It will cause dilution, but at least they have that to give. They can't, if they took out a loan and they couldn't pay it back, and it was like collateralized by their solar IP, they would have to give up the solar IP, and then that would put their company at risk because now they have to pay royalties to whoever owns their their solar IP. So in a way, I think this is a really, really smart uh, vehicle that Aptera and US Capital is using to try to fund their production. But it does have some risks to both the investors and the company, as is true for all investments. So I think that they feel pretty confident that they can raise the $60 million with these terms. And Aptera feels like with these terms that they will cause they're going to get the funding that'll cause valuation of the company to go up, and it's going to increase shareholder value for everyone, even if they do have to dilute. So I think that's the thought process here. All right. Well, I hope that was helpful. I learned a lot reading about this and learning about safe agreements and convertible notes. I didn't really understand what they were until I did the research for this video. So hopefully this was helpful to you guys. Thanks for watching, guys. Let me know what you think in the comments below. Have a great day.